Hello everyone, welcome back to my channel. Hello Charles, welcome back to my channel. And hello Valérie, thank you for joining me today. It is your first time on my channel, so I'll let you introduce yourself.
So hello, my name is Valérie NOEL. I'm a head of trading at SYZ. So thank you for having me today. Thank you, Rashid.
Welcome.
Yes, well, we believe that the bear market is still here. We're still on a very downtrend channel. Even if we took 8% since last week on the Nasdaq or S&P, for example. But yeah, we believe we're still in this bear market. So we have good stuff as the sentiment of everyone is quite low, which is a contrarian point of view. It's not too bad. We've seen also a lot of put buying last week. A lot of people, I would say, 20 billion has been buying by retail last week, which is 3 times the call buying, which is never been done in history. So that's all that kind of thing is quite good. I can really make a rebound of like 15 to 20%. So we still believe the downtrend channel is still in and on.
Maybe just to add on it, because everyone talks about the equity bear market, but actually it is everything bear market. I think what is really unique in 2022 is that for the first time ever, as of 30th of September, so the first 9 months of the year, we have both US equity markets and US bond markets, which are down more than 10%. Actually, they're down almost 20% each. And that makes, let's say, a very unique and difficult time for multi-assets investing. In the past, when equity market was going down, the bond market was kind of offsetting this loss by going up, especially on the quality side, long duration bonds. But this time, everything is going down. And that was particularly the case in the third quarter, because not only we had equity and bond market going down, but we also had commodity market going down. So the only asset which has been going up has been the dollar. For the rest, it has been a bloodbath so far this year. So maybe if I can just start on this from a macro perspective. So it's a very interesting question, because usually you probably know the adage is markets stop to panic when central bank starts to panic, and that's the big questions. The bulls they hope for the Fed basically throwing the towel and do these much awaited Fed pivots. So i.e. stop hiking rates because maybe there's a financial accident or the tightening hurts too much some part of the economy. The reality is that we are not there yet. There are several reasons for the Fed not to pivot. The first one is obvious, is inflation, which is very high. The fact that the job market is still very strong, but also if you look at different asset classes, the spreads, they have widened, but they are not that wide compared to other crises. Volatility is high, but especially on the bond market, the VIX is at 30, it's not at 60 or 80 as we saw in the past. So if you do the checklists, we are still not there yet. So back to your question, are we at maximum pain thresholds? We don't think so.
Agreed. I'm not sure you have to sell everything. On every market, you have also good opportunity. If you look at the past, also October is a month, bargain month, when there is a lot of drop. Sometimes there is a good opportunity to get in. So maybe please buy some protection, like we have seen the retail last week. But yeah, I think protection is very good. Like in life, when you are invest on something or you have something you care of, you actually protect your investment or your house or everything. But on the stock market, people doesn't really buy protection. Actually, when they buy protection, it's a little bit too late. So yeah, be a little bit up in advance and try to buy some protection. And on gold, yeah, I'm not very confident on gold for the moment. I think we can a little bit go down like 15-20%. We are also in downtrend channel, and some rebound are normal, but I feel the pain is still here, and I will be more confident if we reach 1500, 1550 than 1650 that we are now.
Gold has been a disappointment for many investors because it was supposed to be a diversifier during bad times. We have war, there is high inflation, so it was supposed to do well, but that hasn't been the case. Indeed, technicals are still not very attractive, and also what is really penalizing gold at this stage is basically two factors. One of is the strength of the dollar, and the other one is the fact that real rates are going up. So the difference between nominal interest rates and inflation expectations. So real rates are going up, and usually, these penalize gold. So I think to kind of reconcile with the view from Valérie, if you reconcile the technical view from the fundamental view, we are still not, let's say, at a stage where gold, looks that attractive. I can take this. Well, the house view is the following. So, we have let's say a tactical 1 month asset allocation meeting where we can move quite aggressively between in terms of stance on the different asset classes. We have been let's say underweight, or so kind of cautious, or viewing equities as being unattractive for some time now. So we're recommending, let's say, our clients and portfolio managers to be underexposed to equities. Reason being the fact that liquidity conditions are still not there yet. You don't want to fight the Fed on the way up, but not also on the way down. We also believe that there is some risk in terms of earnings expectations, and the valuations are still not attractive. And talking about technicals, if you look at market breadth or the trends, they are still not our friends. So this is why we have been quite underexposed to equities, but we still own some of them. We like, for instance, high free cash flow yielders that can be found, for instance, in the energy sectors or basic resources. Also, some defensive growth stocks. In fixed income, we are positioned on the short end of the curve, more on credits, and also we use some diversifiers with a bit of commodities, still a bit of gold, and also hedge funds, especially macro and CTAs have been very helpful so far this year. And as mentioned by Valérie, it's still time to have some protection. They are not cheap, but they're not too expensive. And that's very, let's say, tactical. But if needed, we can shift our stance and move back to something which is more aggressive. But the rule of the game is that because realized inflation is still very high, you cannot sit in cash forever, and you need to invest. Do you have other ideas?
Yeah, no. If I can just add something about liquidity, we've seen the last week liquidity is very dry on the market, and that's also a very strong movement up and down. And I was talking with other banks this morning, and we've seen yesterday with the market going up quite well in the US, for example, a lot of long only came to sell, and a lot of short covering on a hedge fund also. So I think liquidity is a big part of what we are trading right now. The market is quite dry, and I was talking also about ETF. It's a basket. Under the basket there is underlying, and if there is no lot of liquidity on the market, you can have quite strong movement. So I think it's also something you need to add on your portfolio. I mean, I think to think about it and how you're going to play. For example, in protection, you can play also by volatility and by liquidity, and not only on one or two stocks specifically.
Yeah, this is where you need to be very careful during bear markets. So yes, you need to be liquid, because if you are into illiquid and there are panics and fire sales, you just get very punished on the way out. And also quality is quite important. But I think what was very interesting with what Valérie said regarding liquidity is that it's basically also where the Feds can start to panic, especially on the treasury market. We can see that after so many market makers being forced to close the doors over the last decade because of regulation, because there is quantitative tightening, because foreign central banks are just liquidating treasuries. We can see that the treasury liquidity is shrinking, and this makes, let's say, the Fed very uncomfortable. So actually the risk highlighted by Valérie at some point can become a trigger for some kind of, let's say, rebounds of the market, because then central bank will have to come with some kind of mimic to kind of calm down investors in the markets. Let's start, but it's so difficult as a question that we need a bit of, let's say, woman feeding here. Look, the thing is that if you look at history, all global crises have been triggered by just one small spot somewhere on Earth. So think about 1997. It was about Thailand. Thailand is a very interesting country, but it's a very small stock and bond market. But nevertheless, it triggered a crisis. 1998, it was Russia with LTCM, and 2008, it was a crisis coming from subprime in the US, which is not supposed to be a global thing, but which became, let's say, a global crisis. So what about, let's say, this crisis? All, let's say, big market events, so big market crash, every big macroeconomic, let's say, downturn is very often coming from leverage. So if you think about 2000, it was LTCM was about leverage. 2000 was about leverage of consumers on internet stocks. 2008 was leverage of consumer and banks on US real estate. So where is the leverage nowadays? It's not necessarily with the corporates. It's not necessarily with the consumers. Leverage is with governments. Sovereigns, are super highly indebted because they try to solve one crisis, which was 2008, which was leverage crisis, by more leverage. And interestingly, what happened 2 weeks ago in the UK was really about sovereign, let's say, credibility, sovereign over leverage. And we saw, the result is that, massive sell-off of the pounds and the gilts, big danger on their pension system, creating some kind of panic, which would have, let's say, kind of spread out, across the world. So what happens in the UK can very happen, elsewhere in Europe, or in the US, or why not Japan. So I think this is maybe the common, let's say, the common grounds with what is currently happening is really, let's say, over leverage with sovereigns, and that can indeed create some big shocks. Mm-hmm.
Charles just said, it's like almost a snowball. It can come from not almost everything, but you can start with UK and then you can spread to Europe. You can, like you said, the example of Thailand. Thailand is not very close to us, but it's spread all over the world. And you need to be cautious on country, but also like on commodities and everything, which is a worldwide problem. I would say can be a problem for everyone. So the problem, I can say, can come from a lot of places.
Correlation these days are very interesting because before, like for instance the yen or even the sterling were kind of, let's say, safe havens. So when there was risk off, some investors were kind of hiding into the yen, for instance. Well, the yen is not a safe haven anymore, but as mentioned by Valérie with the UK markets, the gilts, over the last, let's say, 2 weeks, you could kind of figure out what will happen in the US equity market, depending on how the gilts market was behaving. So so yes, back to your question, as mentioned by Valérie, there is, these immediate connections, across asset classes. And two, you never know what can be the trigger, for, let's say, the downturn in let's say in other asset classes, because these correlations are kind of, let's say, moving parts these days. So that's, I think, the complexity that we are all facing. when it comes to Europe, let's not talk about these kind of, let's say, tail risk events, which is war. I think we are already in wartime somewhat, but this kind of nuclear war risk is a bit too much as a tail risk. But I think it's on Europe, we are negative, let's say, on European assets, but I think when you look at the euro and European assets, I think it's fair to say that a lot of the downside risk is already, let's say, in the price when you look at valuation for the euro.
But it's complicated. We're very close to, as Charles said, the war, and it's going to be complicated. Inflation is complicated. Everything is more complicated in Europe than in US or in other part of the world. So, the EPS of the company is still more or less quite high for 2023, and I think we have to be careful also on the company and see how is it going to absorb this.
That's strange. What Valérie just mentioned is that if you look at EPS forecasts, indeed in Europe they keep going up. So I don't know if analysts just look at, let's say, the top line and they say, well, it's good for them to have a weak euro because that means, let's say, higher sales. But they forget that there are also inputs, costs which are going up. So there is almost like a crocodile jaw when you look at between, let's say, EPS for Europe and EPS for the US, earnings per share. So earnings per share for Europe are going up, and then earnings per share for US are going down. And it's true what she said on this. It's a bit strange to see this kind of positive revision, and it might be seen as a good thing on the short run for European stocks. But it can also be seen, exactly. It can be seen as another downside risk, because at some point, analysts will have to come back to reality.
To readjust.
Yeah. Rashid is always he's always looking for the next crash to come. We discussed this once. You need to kind of be careful. The day it will be a bull market, it will be difficult for you to keep your the title of your channel. Look, what we see, with the housing markets, it's true that many investors they kind of think about the last crisis, which was 2008, as similar to the coming crisis coming, and say what happened in the past should happen now. So, as mentioned before, conditions are a bit different. But I think for those who have mortgages, the least we can say, especially with variable rates, is that it's becoming painful. The rise in rates is becoming painful. It's becoming painful in the US. It might become painful in Europe, and as you mentioned, I think you talked about Canada, but there is also Australia or New Zealand. I think the common denominator of the countries which are currently facing the risk of a housing crash is the percentage of variable rates. Because if you have, let's say, a mortgage with 20-25 years, maturity on your mortgage fixed, it's still okay. But here in Switzerland, we have some variable mortgages as well. Yeah. Usually we kind of, let's say, diversify, which is probably, let's say, wise to do. But definitely, it's with rates, going up, interest rate sensitive sectors, are suffering.
It could be an issue for a lot of people.
Mm-hmm. But sometimes it's exaggerated. Like in the UK, for instance, well, these guys, they face an energy crisis, now they're going to face a mortgage crisis. I think in the UK, there is only 1/3 of the population with a mortgage. So 2/3 are not really concerned with this. So sometimes it's a bit overplayed, but again, because I think, we remember all the 2008 crash, and it was all about housing initially. So now, we try to find, let's say, the first cracks in the housing market.
In general.
Yes,
no, I think,
in general.
I think cryptocurrency, 13,000 token. I think it's it's reality, even you believe or you don't believe. It's very emotional. Bitcoin is very emotional. You like or you hate. What we do at SYZ, it's we listen to our clients. Our clients are interested with the asset, so we try to find them some solution. For sure, like everything in life, they will have winner and loser. So we will try to be on the good part with our client and with us. And yeah, it's like, I think you need to make a difference between like Bitcoin and the other crypto, which are more a technology company, and you need to understand how does it work. And then you have also the stable coin, but the stable coin is, you know, something different. It can be compared to the CBDC, what all this currency that will be come up with all the government. So I think you have to separate the cryptocurrency, even if the third is currency, there is Bitcoin, and then you have token that gonna probably change our life at some stage. And maybe we don't know the winner for the moment, but you need to be curious and stay curious with this new asset class.
We had some demand and already over the last 2 years. Maybe you can explain initially how the clients got exposed to the asset class, and without obviously saying much, what will be the future.
Yeah, when it was 60,000, everyone wanted to buy some Bitcoin. Now, to 19, 20,000, people are less, Bitcoin is less attractive, I would say. But still, so we start to have some people who wanted, to invest how they can invest. And at that time, it was only all these exchanges. But for some people, it's quite complicated to go on the exchanges, but all your credentials in the dark, because it's got a very bad connotation, dark, you don't know who's going to steal and everything. So then, the market adapt himself. Then we start to add some ETP, which is exchange trade product that you can trade as an equity, almost like an equity on an exchange. So we've seen some clients, been exposed with that kind of product. Then we have some AMC, active managed certificate, or some funds. So you have a multiple way to invest in crypto. You can also actually play, if it's not the term, but invest in some company who are quoted on the New York Stock Exchange, who are, they use some product. Do you need when you mine? So you need when you do some hash rate. So you can find a way to invest in crypto without buying the crypto. But as Charles said, we try to be a step in advance. So we are looking to help our clients and to secure the wallet and try to accept crypto as a new asset class. And that's actually our aim for very soon.
It's interesting because it all depends also on the age of the clients. So it's very, demographics play a big role.
Yes.
So I think the young generation, the vast majority of them, they're interested.
Yeah, we had a lot of clients who actually called the trading and said, well, Val, you need, it's my son, it's my daughter, it's my niece, they all talk about this, find a way, is it good, is it not good? So yeah, actually it's come from the young generation, and they try to make education to the parents. They probably understand better than them. And
but you need to be ready, as a bank, you need to be ready for the young generation.
For them, yeah.
And this is what we aim to do.
Thank you for your answers. It allows us to understand better our news and the upcoming development. See you soon. Bye-bye.
Thank you, Rashid. Thank you, everyone. Bye-bye.